Hey there, everyone. Welcome back to Daily Crest. I'm Mercy, and today we're diving into a significant financial development that's making waves in the economic world. It's about the recent downgrade of the U.S. creditworthiness by Fitch Ratings. That's right, America just got stripped of its AAA rating, and we're here to break down the $32.6 trillion reasons behind it. Stick around, because we'll be analyzing the implications and potential consequences of this move. But before we get into the nitty-gritty, if you enjoy insightful analysis and news updates, don't forget to hit that subscribe button and ring the notification bell so you never miss an episode. Now let's get into it. The U.S. government's reputation for financial stability took a hit when Fitch Ratings recently downgraded its creditworthiness from AAA to AAA+. This marks a significant development that's caught the attention of economists and financial experts worldwide. While the immediate impact might not be earth-shattering, there are deeper implications that we need to consider. The U.S. government, much like you and me, has to balance its income and expenditures each year. And just like us, it sometimes needs to borrow money to fill the gaps. Over the years, this gap has widened due to factors like the ongoing fight against COVID-19, financial crises, and wars. As of August 1st, the U.S. Treasury owed a staggering $32.6 trillion. Fitch's decision to downgrade the U.S. creditworthiness wasn't solely due to the size of the debt, but also an erosion of governance, citing conservative efforts to hinder the government's ability to raise its debt ceiling. This isn't the first time such a downgrade has happened. Back in 2011, Standard & Poor's did something similar. At that time, it didn't have a significant impact on financial markets. But will history repeat itself? To answer that, we need to understand the risks associated with these credit downgrades. The U.S. relies on buyers for its treasury bonds to finance its operations. These bonds are seen as safe investments since the U.S. government's default risk is considered low. Fitch's downgrade isn't just a symbol. It reflects the genuine challenges in America's financial standing and its ability to manage its debt. If investors start viewing these bonds as riskier, they might demand higher interest rates in exchange for taking on the increased risk. This would lead to higher borrowing costs for the government. This could potentially mean less money available for other important expenditures, or the debt could rise even faster, both of which could have negative implications for the economy. The U.S. government's options to cover its growing borrowing costs are limited. Borrowing more money could lead to even lower credit ratings and rising costs. Alternatively, increasing tax rates or cutting spending could have political consequences and might not be easily achievable given the polarization in Congress. Furthermore, research suggests that higher government debt tends to correlate with lower long-term economic growth, creating a cycle that could compound the problem. So, what does this all mean for us? While Fitch's downgrade might not trigger an immediate financial crisis, it does serve as a cautionary sign for the ongoing fiscal battles in Congress, especially as budget discussions heat up in September. And there you have it, folks. A breakdown of the recent U.S. creditworthiness downgrade and the $32.6 trillion reasons behind it. The economic landscape is complex and dynamic, and these developments remind us of the delicate balance between fiscal responsibility and growth. As always, it's important to stay informed about these financial shifts and their potential impacts. So if you found this analysis helpful, make sure to hit that like button and share this video with your fellow curious minds. And if you want more in-depth explorations of economic trends and news, be sure to subscribe to Daily Crest. I'm Mercy, signing off. Stay curious and stay informed.